Good day, everyone, and welcome to Admiral Markets webinar tips how to manage drawdowns. So, Chris and I will show you how to effectively manage drawdowns and how to actually scale in properly. This is what I always do. I really like to do it, and definitely it's one of my trademarks. It's called scaling in and scaling out, and with those techniques, you should be able to scale down successfully. The biggest thing, guys, is that when you trade, you really need to be well aware of all the risks, and you definitely need to keep it. You really need to keep it safe because it's very, very obvious that the forex is risky business, and that all things that you do should definitely be controlled. And you are the ultimate key to your trading success. So you need really to think about this. Before I start, okay, I will now give you first risk disclaimer, explaining that CFD and Forex are leveraged products and can result in losses that exceed your deposits. And this presentation, of course, is not for everyone, but you need to fully understand the risk involved. And please go to this web address and see the full risk disclosure. This presentation and video is for informational, educational purposes only. And this video is not part of the .co.uk website, but the globaluse.com website. So today's agenda, drawdown and how to manage it. As I say, I will need to use some examples, guys, here, and definitely I will be using some examples from my FX book, because I think that my FX book is also a great way to actually show you some statistics and keep tracks of drawdown and all those things. So for any people who, there are a lot of unbelievers, and a lot of people actually think that you can only lose in forex market. That's definitely not true, and Chris and I can show you and will show you definitely, so you don't need to worry about anything. So okay, so let's I just need to take a quick screenshot, okay, and you will actually see how you can manage it, guys. Okay, so no problems with it. Okay, so drawdown. First, I will explain what the drawdown is. Okay, now this is very important. The drawdown basically is a so-called decline in value. Okay, so in order to understand the drawdown, you need to understand that you will not make profitable trades all the time. The biggest issue with trading is people don't understand that they cannot be forex gods. No one is a forex trading god, because if they were a forex trading gods, right, then obviously all of them would be millionaires, and we will never see losses. We will never see any drawdown. Every single trade will be and would have been a winning trade, and that is impossible, guys. You simply cannot hope that all of your trades will be and will actually be profitable. I've been in this business for 8 years, and if I hadn't been successful with trading and with this what I do, I would have stopped. I would have stopped doing it. But definitely, uh, I know how traders can be profitable, and I have proofs for that. We keep all our tracks and statistics on our account statements, my FX book. So I have the proof for everything that I say personally. Okay, so everything what I say here is, you need to know my personal opinion only, and my personal proof to what I'm saying. So that is why I have the right to explain about drawdown, because I know how to manage it correctly. Okay, again, uh, basic definition of drawdown is that it is a decline in value. I would say for forex trading that a drawdown is a percentage of an account which could be lost in the case when you have a losing trade or a streak of losing trades. So it is basically a measure of the largest loss that your trading account can expect to have at any given moment or a period of time. So drawdown is always described in your trading system. So before trusting any particular system, any particular method, any particular trading signal, you, a trader, should know what is the largest loss you as a trader can face when you start to take losses due to changes on the market that would lead to a temporary worsening of a performance of a trading system. Guys, it's not easy to manage drawdowns, especially if you trade with, let's call it, if you trade with smaller accounts. Of course, trading with higher accounts is definitely much easier than trading with low accounts. But for that purpose, I will show you account statements on the accounts I trade that basically have both sides. Both sides draw down on lower account and draw down on higher account, and you will actually see the difference between those two accounts, and you will see how actually the difference on this bigger account is the drawdown is very low. I mean, I will show you, as I said. Okay, so now we come to the next point. It is basically lack of control over the size of losses. Uh, I mean, it's very easy to get into that so-called revenge trading mode. If you get anywhere in time into a revenge trading mode, have in mind that your losses will probably be substantially higher than if you, let's say, traded normally, because you simply cannot hope that your losses can be controlled until you get a proper knowledge of the leverage used, or you actually know some, let's say, method, or let's call it martingale or other trading method that can lower your drawdown. So the biggest problem with traders is they do not know what to do if they are caught into a string of losses. Then they start to revenge their trades, and what happens, guys? Usually that drawdown is so big that you start to lose, and that is very bad for your trading account. And I honestly think that it is the doom of every forex trader. Definitely it can be the doom for every forex trader. So that is why there are some traders who actually are profitable with only 30-40% of success trades, and also some other traders are not profitable even if they have like 60% of successful trades. So lack of control over the size of losses will definitely lead you uh, to a drawdown. Also, I need to tell you that whenever someone asks you, is there a formula for drawdown? I always say the basic thing. Drawdown is the difference between the account balance and the equity, okay? Or we can refer to a drawdown as the peak to true difference in equity. With managing slow drawdowns, I personally have had success in my forex trading career. And you need to know, guys, that I started to trade publicly on Forex Factory. My name on Forex Factory is Tarantula. And when I started to trade, uh, I got pretty much good reviews with how I put those trading ideas, signals, and how I advise traders to use that thing that is called drawdown. But when I started doing that originally on Forex Factory, I personally I use like 1 to 100 leverage. So that was the time when brokers didn't offer 1 to 200, 1 to 500, 1 to 888, or even 1 to 1000 leverage. That was the time when Forex was still, like, not regulated that much like it is today. And basically today you can see there is a lot of discussion regarding leverage, but my opinion is, and I'm sure about it, and I can always prove to anyone who asks, be it a regulator, I mean global regulator like ESMA or FCA, or let's say retail trader, that small drawdowns can be managed effectively with the use of higher leverage. Because I haven't been always, my accounts, let's say my accounts have not always been in profits. Very often I manage to get into the, let's say, positive territory. Even when drawdown was 60-70%, I managed to get into a positive territory again, guys. Believe me, it's the truth. And how I did it, I did it basically with the proper use of the leverage. And that is what I always want to show traders, how they can manage their effective drawdown with the proper use of the leverage. Without it, guys, without good leverage, okay, you cannot manage the drawdown effectively. I mean, you will be probably stuck in a trade, and it won't last forever until you're actually stopped out. You will be probably margin called, and definitely you won't be able to get into a positive territory. So it's very good, guys, that you actually understand, okay, the point of drawdown. Okay. Okay, and just a few seconds to answer a question. Okay. Okay, so yeah, I mean, you can always ask me, guys, if anything is not clear. I will definitely explain whatever is not clear, and I will show you during this webinar examples, guys, of my the account the accounts that I trade on my FX book to see the actual drawdown. So again, small drawdown, you can have success. With large drawdown, guys, I think it will bring to unhappiness, and you will probably be margin called. Okay, now let me show you the examples, and I will give you techniques for successful drawdown management. Okay, the first here, guys, is the example, okay, of okay, this is, wait, just give me a few seconds. I need to open the, okay, okay, and this would be it. Some examples, wait just a few seconds. You see, this was the example before the actual trade was closed, and this is the better example, guys, of one of the accounts here that I trade. You see on this account here, it was basically the gain is 118.34%. But you see the size of this account. I made 220 euros deposit, and as I always say, I made this, guys, just to show traders how they can double their account with the effective use of provided leverage. And basically, you see here the highest drawdown on this account. This is a small account, but my aim is to make 5,000 out of the 200 euros. If I manage to do it, of course, I will publicly announce it. But still, guys, you see it's like 118, and absolute gain 100.5% in let's say a week of trading. Basically, the drawdown was 57.56%, but my calculations and my statistics show that my average drawdown on these low accounts is usually, let's say, in between 35 and 65%. So I know how to deal with this drawdown, because obviously I managed to get into a very positive territory, okay, into a very positive territory by using scaling in techniques, okay, scaling in techniques, scaling out techniques, and the effective use of leverage. This is what I will be going through and what I personally will be showing you, and then Chris will also continue with his tips. Okay, so this is one account. Okay, now let me show. Okay, just see, it's 57.56% of a drawdown. Okay, now let's get back to my next new account. Okay, and this is what I will show you. Just give me a few seconds. The account that I also recently started to trade. Okay, here, guys, it's again a verified account on my FX book, and you can see here it's 100K, and the drawdown is only 0.16%. Okay, the account is already again, it's a week of trading, and you can see that this account made a gain of only, it's not only, but it's like what you can get if you put the money in the bank over the course of a year. Because usually if you put the money into the bank, your effective return on investment will be like 1% per year, right? So in this example, you can see it was like 0.49% gain, very conservative trading, but you see drawdown is indeed 0.16%. So basically the point is it doesn't matter, guys, if you actually trade with big money like 100K, right? I mean, for some people this is big money, for other people this is not a big money. No, it depends really what your take is, but I think that 100K is okay. It's good money, right? So it's like it's much easier to trade and to manage the drawdown effectively than it is basically with the account, with this account. Okay, with, let's say, this account, or eventually let me just find it where it was of all these pictures, with the account where yes, this one, where I have a 118% gain, but you see it was like 57.56 of a drawdown. Now let me get back to some things that I think are important. For example, this is a special technique that I often use when trading. It's called scaling in, and basically this is how you can manage also your drawdown more effectively. We will talk about leverage in also, let's say, 5 minutes, but scaling in is a special technique, and actually it means entering trade in pieces. Why in pieces? Because you don't always put the whole risk into a single trade. You can divide your risk into different trades. For example, that scaling in technique I showed today on my live webinar that I had with Admiral Markets here. And here you can see it was the webinar is real-time daily trading ideas. I made trading ideas for dollar CAD, DEX, and euro dollar, and dollar CAD went into a nice profit. So you can check the webinar, see it. And here on this webinar, I also showed how I use scaling in. So for practical scaling in, you can easily just watch this webinar, guys. And of course, I always have proofs for everything that I say. This is what I showed after the webinar, clear result, potential result that happened after it. So you can always watch it and see the scaling in real time. I will also show some examples here via these slides. So it's effective, of course, in slow markets when price is actually entering the zone, and of course it uses a different approach. So-called scaling in or adding into retracement is actually the basic definition is that you take trades in pieces, but before you decide to take a scaling in trade or general trade, you need to calculate your risk. So if you want to keep your trading under control, you need to give price a room to breathe. That is why on my trading system, when I see the signal, I don't immediately rush to open a full risk potential. So let's say, and I will use the example on the MT5. Give me a few seconds. So let's say that today, actually, I traded dollar Swissy, and let's say that my entry on my system, it was a signal that I should take a trade in between here. This was basically a signal 94 69 70. Okay, let's say it's 70. So I got a signal to go long here. Now, what happens is usually this is the case with all indicators, with most of the systems, guys. Basically, when you have a signal, the price will either immediately rush into a positive territory, or it will actually drop into the zone further. So the zone that I had today for dollar Swiss buy trade was in between 94.60 and 94.70. So it was like 10 pip buffer. I always trade with 10 pip buffer zone. So my first entry is 24.70, but my second entry was made when price dropped a little bit into this territory. I usually go with 5 pip in between. So if my entry was 94.70, I would actually add one more trade around 94.65. If the price dropped a little bit further, depending on my risk, I would either add more or I would leave with the trade with 2 positions. You need to, guys, remember that, because that is the proper way how you can scale in. But before you actually do it, okay, before you do it, you need to know what is your maximum risk. Depending on the size of your account, guys, okay, depending on the size of your account, you should pre-calculate the risk before you rush in a trade. And this is, guys, euro dollar example, pure scaling in, that I told you. I put this during the live trading webinar today with Jens. You see here 0.10, 0.10, 0.10, 0.10, 0.10. 5 different trades with 0.10 lot sizes. Again, if you want to see how I did it live, just go to webinar that I show you today, real time trading ideas with with Jens and me, and you will see that how I did it with using this mini terminal tool. So what I expect here, for example, is if the price gets down, we can buy euro dollar, but I will use scaling in. So this means that if the price gets here and spikes, I will only have 0.10 lots running. If the price gets a little bit down, it will collect all of my 0.10 trades with a full risk of 0.50. And if it spikes, my profits will exponentially go up. Also, you never move your stop loss further. You need to have fixed stop loss. So before you decide to take a trade, okay, for example, if your risk is 2% per day and you open your first trade with 1% of risk, you still have that another 1% of risk margin to add into your trade. So guys, my advice is please use your risk management. You cannot trade without a plan. If you want to trade 10% of risk, it's up to you. If you want to trade 5 or 2% of risk, it's again up to you. But this is how you manage it. If your risk is for trade, let's say 2%, and you put 0.50% of risk, you still can risk more with scaling in technique. Irina, this is Admiral Markets YouTube channel. Okay. The website that I showed you, okay, was actually Admiral Markets YouTube channel. If you don't know, if you're not sure about the website, it's YouTube on Admiral Markets, and my FX book is well, you can have all statistics there. It's myfxbook.com. So log in, see, connect your account, and analyze your account, see the performance. So let's get back to my example, on on euro dollar, and I will again explain. So let's get back to euro dollar example here. So you see, guys, a lot of limit orders there. Okay, so if I decided to go with 1% of risk, this first trade here is 0.20% of risk. This is 0.20% of risk. Next one, 0.20% of risk. 0.20%, 0.20%. When you sum it all up, it's like roughly 1% of risk. But the risk is actually a little bit lower because you see, we never move stop loss. We leave our stop loss running. And, well, what can happen is the price. I'm just showing you guys as an example. Okay, treat this as an example for scaling in. So divide your risk. You can have 2% of risk in 30 pip stop loss, in 50 pip stop loss, and even you can have it with 1,000 pip stop loss. If your account is big enough, you can put the same 2% of risk. So stop loss is dynamic thing, while risk is fixed thing. You should treat it as that, okay? Stop loss, a dynamic thing, risk is a fixed thing. And this is how I do it. Now let's get back to next thing. So you determine that maximum lot size for 50 pip stop loss trade is 0.4. This again, this is account dependent. Your account and my accounts are not the same. You need to know how big is your risk before you enter a trade, how big is your stop loss before you enter a trade. And let's say that for this example, with 50 pip stop loss, your risk is, let's say, 0. You can use 0.4 lots, which fits into 2% maximum risk. So you don't enter with 0.4 lots immediately. This is the price. It doesn't matter which pair. We just use it for the webinar purpose, okay? So 0.4 lots at 36.80. We don't use all this risk immediately. So we open 0.2 lots. The price drops to 36.60, okay, where you add another 0.10 and 360.50 one more before price went up. So you added 0.2 at 36.80, 0.1 at 36.60, 0.1 and 36.50. Okay, so you're trading full risk now. It's 0.4 lots. So your positions are
Hi traders, sorry, somehow I'm talking to Nenad in the meantime and trying to get him back the access, the presentation, but that is not working out somehow. Nenad lost the presentation floor. I'm not sure how, but unfortunately he did. And some technology glitch here. I'm trying to see if I can get. Maybe I can find him. I'm trying to find him. Ah, I see him. Wait, maybe let me see. Yes, make presenter, make organizer. All right. I think I managed now to find a way to give it back to him.
Excellent, Chris. Thanks a lot. Yeah, somehow I was kicked out from the webinar. I don't know why it happens. I will continue, but I hope that we will not have those problems anymore. So, yeah, again, where was I actually here? Okay, let's get back. So, we made these entries, we made this stop loss and this target. If the price goes into our favor and hits our target, okay, then you would be making 180 euros for a first position, 110 euros, okay, for a second position, and $120 for a third position. So we would have made like $410 total. If you enter at 0.4 at 36.80, you would have made $360. That's $50 less than 410. So this is the reason why the profit goes exponentially up if you scale in. This is very, very important. Profit goes exponentially up if you scale in. Okay, now let me show you another example. If the price hit stop loss instead of profits, same thing applies. 0.2, 36.80, 0.1, 36.60, 0.1, 36.50. And effectively, we lost a trade. If the price went against us and hit stop loss, okay, then the loss will be $100. I'm using dollars. It doesn't matter. The principle is same, just the difference of pip value. But just for the sake of presentation, we are using these statistics. $100 for the first position, $30 for the second, $20 for the third, and $150 total. But if you had entered at 0.4, you would have lost $200. That's $50 less. Okay, $50 more actually than uh, the scaling in technique, and that is the reason why why actually losses are exponentially lower if you use scaling in technique. That is one of the reasons why I really prefer to trade with this scaling in and scaling out techniques before I actually make any substantial profits or drawdowns. For me, this is one of the things that I like to do. But again, guys, if your account is very, very low, it will probably take some time before with this technique you actually raise it to some percent. But again, your drawdown would be exponentially lower. Never ever chase the trade, okay? And the most stupid way to scale in is if you don't trade with a stop loss and you are adding into losers. So what would it mean is for example, you entered a long trade here, but you don't know where your stop loss is, and the price keeps dropping, and you're just adding into your positions without any stop loss. That will probably kill your account soon. This is how you should do it. Put your full risk into 5 different trades. Do not risk much and just place a stop loss, fixed stop loss. You never move this stop loss. If the price hits all of your pending orders, bang, and it goes up, then you will definitely make some decent pips. Okay? Enter exponentially. Don't enter your full lot size at the beginning. Do not move your stop loss. And proper scaling in requires a proven system, a method that definitely will actually allow you to use these zones and scaling ins. Your first trade should be small. That is why I advise using lower leverage. Add a risk on your second trade if the first one is successful, but keep it below 5% total. The leverage should be used wisely. If your account drops really to the point of, let's call it, no return, then I advise you, this is my advice, to use the full leverage to recover. So it will be either break it or make it. This is how I did. When I dropped 57%, I said, okay, is it better for me to lose 130 euros or to try to risk it with good leverage and try to make it up for all losses? And you saw my account, small account, went from 200 to 430 euros by smart use of leverage. So you need to keep your risk small, but when things go wrong, go bad, then use the leverage and say, okay, this will be either make it or break it. That is what I call smart use of the leverage. Because, guys, when you trade, you need always to trade with the amount you can afford to lose. That is the primary thing. Trade with money that you can afford to lose. Because your objective is to keep your losses under control and make profits. It's not otherwise. Okay, it's not vice versa. Thank you, guys. If you have any questions, feel free to ask me. Chris will continue now. Cheers, guys.
Sorry, folks, I was looking for the mute button there. Here I am. Indeed, great stuff from Nenad. I'm going to continue indeed. Let's start this PowerPoint. There we go. All right, that's the first slide. So we should be good and up and going. So yes, drawdowns, Nenad talked already a lot about it. Let me share my 2 cents here about that. So obviously, drawdown is something that we're going to have to encounter, at least something. It could be small, but it's always going to be a little bit. And there's nothing we can do about that. That's just part of trading. And not all traders really realize that. Not all traders are prepared for that. That's why it's so important, because ultimately, we need to be able to handle those drawdowns if we want to achieve long-term profits. Because, from this perspective, if we're not prepared, it's going to scare us, and there are all kind of disadvantages that arise when we're not prepared. And it's something we're going to bump into no matter what, right? It's always like that. You never can have like wins and that's it. There are going to be losses, series of losses occasionally. So that is something that is to be expected when we trade long term. We could have win streaks that last for a while, for a short while, but in the long run, we're going to have that. So it's important to understand more about this drawdown and whether we have a profitable kind of equity curve expectation, and to know more about this. So what kind of drawdown could you expect? We must expect it, but what kind of level? Obviously, it depends on your trading style. How aggressive are you? What kind of risk you take? What type of trader you are? You got to find a balance. You got to find something that suits you. Some traders need to take a little bit more risk. Maybe 0.5% of risk, 0.5 could be too little for some traders because they get bored. Other traders, it might be too much. They might rather take 0.25% because they feel more comfortable with that. So you got to find that border. Obviously, there's a level that the risk is too much, and you're starting to go into gambling territory. But that's more of a risk management webinar. With regard to the drawdown you could expect, as I said, it depends on your personality, and the risk you take. But if you typically try to aim for making 5% in a month, then very quickly you should expect that the drawdown could be the same, 5%, right? If not more. It depends also on your skill level, what type of strategies you have, but it could also easily be that you could expect 10% for 5% drawdown. Definitely, if you're targeting 5, it's very likely that you're going to have at least 2.5% drawdown, and that's of course very modest expectation, right? It could easily be 5 or 10. So that depends on a lot of factors. So if you're aiming for 15%, well, then you should expect anything between 7.5 and on the low side and 30 on the high side, right? So can you handle a 30% drawdown? That's something you need to figure out. And of course, if you are aiming for higher percentages, you quickly realize that that potential drawdown could be way, way more if you follow those examples, right, down the road. So drawdown is very important because of the trading psychology. It is important because we need to match our drawdown equity curve strategy and trading psychology. And, it has to be kind of a fit with those three things. As I already explained, there has to be a balance in the risk management you take and the tolerance of risk. So if you have, say, you don't want to incur a drawdown more than 10%. 10% is your max, but you're taking 3% risk per trade. Well, 3 trades and a little bit, you're already hitting that max. So you can only have a very small drawdown before you already have to stop that week or month. That's not a good balance. So having a certain drawdown in mind is good, but then you have to, think about how you build your risk management plan so that it makes sense in combination with that drawdown. So the risk management and drawdown are important to make a good fit and match. The same is with your strategy and your trading psychology. Now, as with everything in trading, whether it is your drawdown, your equity curve, whether it is a trade that fluctuates up and down, or price that moves up and down, it is very typical for the market to do that. And we have to have thick skin, if you know what I mean. You have to kind of like really be sturdy in your shoes, as another example, is another expression. Or you got to be really like kind of up to the task to be able to handle these ups and downs. It's really important part of trading, because I think most traders ultimately have like bump into fear when this is going on. A lot of, I think, let's say, scary actions, decisions that are not optimal, are made during these times. All right, and as I already explained, tough on the trading psychology. It is most likely point where traders quit and they stop. And it's very important to find a drawdown, an equity curve that you feel comfortable with. All right, I think I kind of explained this one already. All right, let's move on. All right, so why is taking fixed level of risk important, and why is limiting your drawdown important? Because the lower your volatility, so if you always take 1% risk, let's just keep it simple, and you always lose 1% if you lose, then your volatility is going to be way lower. If sometimes you lose 2% and sometimes you lose 3 and then 5 and then another time you lose 0.5%, when you start to calculate risk management numbers, your volatility will be way higher. What is the disadvantage of that? Well, if you have higher volatility, you need a higher return to justify the volatility. So that's going to be more difficult. And that might not sound that exciting, but it is an important number. You want to keep an eye on the fact that you're not risking a lot. You have a lot of volatility for a small gain. Why? Because ultimately it might work in the short term, but you're going to hit a rough patch maybe eventually. As I said, drawdowns are unavoidable, and it's going to hit you as a boomerang, because those small losses might be good, but eventually you're going to hit those bigger those smaller wins might be good, but eventually you're going to hit that bigger loss, and it's going to be difficult to climb back out of that. So stick to your risk management, stick to a fixed percentage of your loss. That's going to lower volatility. and you're going to need relatively less return to just justify that risk. All right, so look at this example here. If you made 25%, what is better, 25 or 30%? Your answer should be, I don't know. Many traders would be tempted to say plus 30% is better. But the real answer is, I don't know. And the reason is because we should know the risk side. What is the volatility that you're enduring to gain 25 or 30? And if the risk is less on 25%, let's say the drawdown is 20, then actually 25% is better. And the drawdown on the 30% is 40, well, definitely 25% is better because you're risking half to gain about the same, just a little bit less in return. All right, you see that? It's very important. Many retail traders don't look at this, I think, is my feeling. But traders at institutions, big funds, this is very key. So when thinking about risk tolerance, choose a risk capital that you feel comfortable with. Whether that is 200 euros or 1,000, I don't know. That's only you can decide. But it should be an amount that you feel comfortable with, and that if you lose, nothing changes. And I'm talking about losing everything. That's the risk capital that you can take. Then take that risk capital and use a risk management that you feel comfortable with. So if that's, let's say, for example, 5,000 euros, if you feel comfortable with that, trade that capital, and then say, okay, I am a type of trader that takes a little bit of risk, but not too much. Let's go with 1% risk per trade. All right. And your maximum drawdown that you usually encounter not more than 10%. So you could say, okay, in a month, if I hit 12% drawdown, I stop, right? My target is 15%, and I'm taking 1% risk per trade. So you got plenty of space, for instance, this is an example, right? But you got plenty of space before you hit your max, and you feel comfortable with that risk, and you feel comfortable with that capital. But in any case, whatever you choose, be consistent in implementing it. So, all right, yes, let's move on. Consistency, in any case, is important. As I said, you want to, I already talked about this, you want to first of all ask what you feel comfortable with losing, all right? Then think about the goals, all right? So if you feel comfortable with losing 12%, for instance, then you can see what you would have or would typically reach with that particular percentage, and see if that is interesting for you, whether that is maybe 6% or 8% on average. I don't know. It depends on what kind of strategy you have. You can also flip it around and say, okay, you know, I have a typically 10 losses is the max losing streak. I don't want more than 20% drawdown. So I can take not 0.5% risk, actually 2% risk. It's the other way around, sorry. 2% risk per trade, right? Because if I have 10 losses in a row times 2%, it's 20. So that's also how you can calculate what risk you can take per trade. You can, rather than starting with the risk per trade, you can say, this is my typical losing streak maximum, this is the drawdown maximum, and then calculate what the risk is per trade. Try to be a little bit careful with the losing streak, not too optimistic there. And last but not least, this is a great way of measuring how sturdy is your strategy. Is it based on luck, or is there a consistent long-term profitability expected? And you can calculate that. It is called the T statistic. This is a great thing because it explains what the likelihood is. So let's say your account starts here, and you see a positive progression of your account. Let's say something like this: up, down, down, like this. All right. So you're wondering, is this a positive? I mean, it's positive, right? But was this based on luck? If you would repeat it 10 times, would you get roughly the same results? Or would they be in 9 of the 10 times totally different? Let's say you do this 10 times, and once you end up here, which is what you encountered now, but another 10 times, 9 times, you would have here, 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 here. Let's see, that's 9, 3, 6. Yeah. So were you lucky? This is positive territory. This is negative territory. And the answer is yes. You were very lucky because you got, by coincidence, the best result that you could have had. So if you do that again, well, probably it's going to be worse, isn't it? And the results are very wide. There's a very large distribution. So it is pretty much random, very random. So it's not going to give you too much of a long-term incentive or consistency. Now compare this to a strategy that does this. And the other 10 results are here. All right. Now, are you lucky? No, not so much. It's just about what you would expect. All right. You might have some cases where it's a bit lower. You might have some cases where it's a bit higher. But a lot of them are roughly around that area. So is there a lot of volatility here? No. Right? So if you do this again and again, would you expect about the same? Yes. So is this consistent? Yes. Is it not so much based on luck? No, not so much based on luck. So this is kind of what the T statistic is basic, or not, yeah, this is what it's really indicating. And how do you calculate that? Well, basically, you take the expectation per trade. So you have a bunch of results. You have 40 trades, minus 1% plus 2%, right? That's what you expect that's the result per trade. And it's a bit of a math. You need to know the standard deviation. So you calculate, it's been a while since I calculated this. I forgot, to be honest. You calculate for the whole 40 trades the deviation between those trades. So you get, if I remember correctly, so bear with me here, I'm not 100% sure, but I think that's, if I remember correctly. So you get all kind of results. Then you get kind of the standard deviation. That's some kind of number based on all these 40. And then you multiply it by the square root of number of trades. So 40 and the square root of that. And so you get, let's see, so this is divided. So the expectation divided by the standard deviation is a number. I think you calculate all of that and then multiply it by the square root of that. So anyhow, best is to research that. But when you Google T statistic, but this should be the formula. And anything that is above 2 is very good. So that gives you an idea. Now, the higher the better. I mean, if it's something like 3, 4, 5, I don't know. You know, I don't know how high it can get. 6, 7, 8. I don't know if it's higher than that is possible. But that is excellent, excellent, excellent. As far as I remember and know, anything above 2 is good, though. If you're below 2, then you might want to see if you can improve it, see if there are ways to get better. All right, folks. Well, that was my part. Thank you for joining. Of course, more info on the website, admiralmarkets.com. You can reach out to the YouTube channel, Facebook, and of course, email or phone for that matter. So feel free to do that. Nenad and I are back soon with more webinars next week, and wish you all good trading in the meantime. You can check out admiralmarkets.com for not only webinars, of course, but also about how to start trading, what instruments you can trade, a wide range of instruments, going from CFDs to currency pairs to commodities, uh, what platforms you can use. Check out the Supreme Edition. I recommend that with a lot of extra features there. And of course, analytics as well, and a lot of good tools such as Market Heat Map. Market Heat Map. All right. So that's about it. See you all soon. Cheers.